When stock prices start rising and falling in fierce waves, could you calmly sail these turbulent waters to reach the potential treasure at the end? Pirate metaphors aside, for experienced investors, jumping on trades during times of market volatility could offer both an exciting challenge and a profitable endeavour. So if you like the cut of this investing jib, in this video I'm going to talk you through what a volatile market is and how you can prepare for one, as well as 3 popular investment strategies and some of the risks. A volatile market is one where share prices rise and fall significantly in a short period of time, sometimes even within hours. Lots of factors can trigger a volatile market, from economic releases and company news to initial public offerings, unexpected earnings results, and tiny little minor things like a global pandemic. Volatility is usually measured by standard deviation. The higher the volatility, the higher the risk. Check with your broker or trading platform to see if they have information on stock volatility, if this is an area of investing that piques your interest. Before you even think about investing in a volatile market, it's a smart idea to start building up a diverse portfolio of investment assets. Spreading your investments across a range of different financial products, sectors, and countries could help stabilise your overall investment if one stock or sector were to crash. It's also worth thinking longer term. Volatility is like turbulence when you're flying. It does pass, you just need to keep calm and stay the course. It's hard to predict when a market will turn volatile, so it's best to do as the scouts do and always be prepared. Take the steps you need to take now to make sure you're ready in case of any eventuality. Trading in a volatile market is extremely risky, so don't invest more than you can afford to lose and make sure your living expenses are covered before you take the plunge. For all the complicated, mind-spinning nuggets of advice out there, there's always one simple solution that blows it out of the water. Ignoring market fluctuations speaks to a longer-term strategy. It's about keeping your head down and just riding out the storm. For this to work though, you'll need to have a well-balanced, diverse portfolio and the flexibility to keep your money tied up in your investments for several years. With that in place, kick back, relax, and wait for the sweet moolah to roll in theory. If you're only able to invest in the short term or are prone to panic when your investments start to fail, opting to invest in less risky assets could be a good strategy for you. Although, if you're the ultimate freak-out Frank, you might want to consider whether investing in any kind of market is really for you. Less risky assets could include government bonds, gold, and currencies. These are considered safe haven investments, which means that they tend to fare better than other stocks when the markets are going wild. The third strategy would be to consider trading options. This type of trading gives you the right to buy a stock for a set price for a set period of time, even if you don't then go on to actually buy it. The idea is that you see potential in the stock, so you essentially put down a deposit with the hope of buying it in the future. But whoever said there's no such thing as a free lunch clearly traded options, as you will pay a premium for this, and as with any kind of investing, it carries its own risk, such as the risk that the price won't work in your favour and you lose the premium. You can also use leverage with some types of options, which means you could lose more money than you invest. Trading in a volatile market will put your investment acumen and portfolio to the test. So if you think you're ready for the challenge, head to fineco.com/UK for more detailed information on this style of investing. Links are in the description below. For more videos like this one, hit the subscribe button here and stay tuned for our next video. Thanks for watching.